Okay, good morning. Thanks so much once again for joining us here at the Network Breakfast. We're going to talk about savings accounts and how Americans are saving and what their trends are. But before we get to that, we'd like to go around and say good morning to each of our contestants today, and they'll say good morning to you. So we're going to start with Mike Bentley, and he'll say this. Good morning, Mike.
Good morning, all. I'm so glad that you could join us for the Network Breakfast, and I'm here to tell you a little bit about me. I work primarily in the area of health insurance, whether you're an employee that's transitioning, questioning COBRA coverage versus individual coverage, you're someone who's graduated to Medicare, you're confused, you see all the commercials on TV, you need some guidance. You're getting ready to travel overseas. You need travel health coverage. I'm the guy to give a call. Mike Bentley from the Brooks and Stafford Company. Thank you.
Thank you, Mike. Thanks for being here. And now we'd like to say good morning to Jeff Hexter. Good morning, Jeff.
Thank you, Tom. I'm Jeff Hexter with Always Keep Computing. And the word of the day is defenestration. So if you know anybody, defenestration, by the way, means throwing something out a window. If you know somebody who wants to throw their Windows laptop out the window, I'd like to be there to catch it and maybe try to help fix it. So I'm looking to meet with the professionals working from home who are struggling with their laptop problems these days. Jeff Hexter, Always Keep Computing. We pull out our hair so you don't have to.
Excellent. Thank you, Jeff. And sometimes Jeff can actually repair your computer online. He'll log in using various apps and fix it that way. And also, let's remind everybody about Jack's Deli, Wednesday morning, 9 to 11. Jeff Hexter's there at his round table and takes care of phones and tablets and computers. Okay. Thank you, Jeff. Thanks for being here. Now we'd like to say good morning to Chris Walters. Good morning, Chris.
Good morning. Chris Walters with See-Through Windows. I provide vinyl replacement windows, glass block, and patio doors. I cover a territory from Port Clinton to the Pennsylvania border, Cleveland to Canton. I go take a look at every job, and within 24 to 36 hours, you'll have a quote, and all you got to do is okay it, and then we'll put you on the schedule. My number is 330-604-0403. Thank you, and have a good day.
Thank you, Chris, and thanks for being so concise. And no wonder you're so successful. I appreciate it, and I thank you for being here. Good morning, Rob Lord. That's it. Thank you.
Oh, I know. I got a lot of racket going on here.
Yeah, appreciate it.
You didn't want to hear it.
Okay.
Rob Lord, Thriving Financial. I'm a financial advisor helping you get to and through retirement, holistic planning, and helping you steer through the markets in a crazy, crazy world today. Money is green, and there's no pronouns. Rob Lord.
Excellent. Thank you, Rob. And also, when I'm going through my presentation, anytime I mention talk to a financial advisor, I could have and should have inserted Rob Lord and his phone number at each and every point in the presentation. It would be Rob Lord that we recommend here at the Network Breakfast for your financial help. Thank you, Rob. Thanks for being here. We're going to say good morning and let her say good morning to us, to Trina Gigax. Good morning, Trina.
Good morning, gentlemen. Good morning, everyone. My name is Trina Gigax. I've been with this group for a while. Almost formally, I'm on my last project as a freelance copywriter, copy editor, and I became a cancer patient, cancer mentor for anybody going through cancer who needs help with perhaps getting social workers involved, nutrition, figuring out your finances, emotional support, how to deal with family members, just all aspects of having cancer. I'm here to help as a volunteer, Trina Gigax.
Excellent. Thank you, Trina. And once again, thank you for being here. Thanks. And now we're going to move on to American Savings, and I will share my screen, and it'll look like this.
Tom, you need to introduce yourself. Last but not least.
Oh, Tom.
I'm calling you out.
All right. Thank you. Thanks, Rob. My name is Tom Basie. I'm here in Northeast Ohio, and I can help you with anything that has to do with a computer. As I say when I'm going around town here, if you put your hands on a keyboard today, I can help you make that computer more productive and help you stabilize your career by being better at everything than everybody else there, and I can help you do that. I'm Tom Basie, an IT professional here in Northeast Ohio, and thank you, Rob, for dragging that out of me. Okay, now we're going to continue on with, I'm going to share my screen, and it's going to look like this. We'll do several of these. A look at the average American savings in 2022. A new survey shows that the average American has less than $1,000 in their savings account. And as we all have a collective gasp, could that be? Well, in this particular graph, you can see that the blue area, 34%, has zero. The red area, less than 1,000, 35%. And the green, 1,000 to 10,000. And in the dark blue, 10,000 or more, 15%. Now, what we don't see on this is how they've come about this. And there's ways that we categorize our savings in our education, in our earning potential, and our education. So now we're going to delve into that, and you'll see how that goes. Many factors affect the average American's savings, including age, education level, and income bracket. Retirement savings is considered a different pot of savings versus total account balances. Ways to increase savings include creating a budget, automating savings, consolidating debt, and speaking with a financial professional to make a plan. In this case, that would be Rob Lord. The average American savings varies by household and demographic. As of 2019, per the U.S. Federal Reserve, the median transaction account balance, which would be checking and savings combined, for an American family was $5,300. The mean, or the average transaction account balance, was $41,600. And I'm going to show you a graphic after this panel of mean versus median. With these figures in mind, how much does the average American save a month? Savings-specific data are difficult to come by, but the 2019 Federal Reserve Survey of Consumer Finances provides information about transaction account balances, which cover both average checking account and average savings account balances. Here, we'll primarily explore the latest transaction account balance from this survey. And once again, here is our graphic for the median versus the mean. You can see the median is you take all the numbers and add them up and divide them by the number of numbers, and there's where you get your median. Whereas the mean is the middle area of all the amounts. So that means when we say there's 46,000, there's a lot of them that don't have anywhere near that, and there's some that have way more than that. So
I think you're confused. I think you've reversed the terms. The mean is the arithmetic average. You sum up the numbers, divide by the number of numbers. The median is the middle number of the list of numbers.
Yes. Average savings by age. We can identify savings trends based on age. Older age groups, for example, generally have a larger mean and median account balances, though some exceptions exist. A more than $6,000 differential appears between the median account balances of younger Americans and younger than 35 and Americans older than 75. And here's some key statistics. We went over a little bit of this last week, and we looked at this, and this actually breaks it down into the age group, the median, and the mean balance of accounts. Younger than 35, you could see they're just starting up. There isn't going to be much there. And I believe Chris brought up the fact that it seems like the 35 to 44s or the 45s to 54, they got their head in gear and started really saving and making more money, trying to do better. And you could see that goes all the way up to 65 to 74 and 75 and older. This is not to say that the average Americans, as you saw on our first graphic, there are some 34% that don't have anything. So this is for those in a particular earning bracket, a particular age bracket, of course, and a particular education bracket. Average savings by education level. The data on the average American savings balance also correlate to education level. The data concerning education support the conclusion that more education typically translate to higher bank account balances. Higher education likely explains the difference in savings levels. It paves the way to higher paying employment and thus the ability to save a percentage of one's income. And here are some key statistics. We have no high school diploma, median account balance, and of course, mean balance of accounts. The high school diploma, it doubles. Just to get a high school diploma, it doubles. These are only, these aren't actual, I mean, if you're in a better job, your numbers will reflect, but it'll be higher than this. Or if you're not in a well-paying job, even with a high school diploma, it won't be this high. With some college, a lot of us out there have a year or two or three, didn't graduate college, and it really helps. You can see that it boosts especially the median balance. It boosts it. And a college degree, then you're going to be pretty well off if you can manage to get through college. And that's what our mothers were telling us when we were kids. Please go to college. You'll be so much better off than your own father. But maybe your dad was a genius. Average savings by income percentile. The Federal Reserve's data also shed light on the relation between income and account balances. The income data suggests higher income correlates to higher savings. For example, Americans who earn less than $20,000 have a median account balance of nearly $70,000 less than those who make $90,000 to $100,000. Well, that's a pretty drastic difference if you're making $20,000 versus $90,000 to $100,000, and that would explain why it's $70,000 less. And here's some key statistics to back that up. Income percentile, less than $20,000, median balance accounts, $810. Mean balance of accounts, $8,400. And you could see that rides all the way up to those of you out there making between $90,000 and $100,000. Lucky you are. And you'll see that it's 70,000 and 190,660, respectively. These are pretty decent numbers, and it's probably based on your education, puts you into this income percentile. Okay, I just knocked it off. Okay, there. Boom. Average retirement savings. Researchers have also looked at retirement savings, which is typically considered a separate savings concept from traditional checking and savings account balances. Looking at these data are correlated to age can highlight the way American households save money when preparing for the future. Keep in mind that the amounts are shown in the tables for ages 75 and older reflect the fact that these individuals are likely drawing on their retirement and or no longer contributing to their retirement. Here's some key statistics. And you'll see that retirement balances. Younger than 35, you're just starting out, and you're going 75 and older. These are, of course, probably not representative of the total of America, but it shows the median and mean 83 and 357,920. Wouldn't we like to be part of that? In fact, I would say that our group here probably is part of that. Tips for maximizing your savings. A thorough approach to savings is essential to any financial plan, and creating a strategic approach is a deliberate way to boost savings. Saving wisely can help you achieve financial goals while ensuring you have enough emergency savings in case of unexpected expenses. Saving tips include, that would be create a budget. Budgeting can help you know exactly where your money's going each month, enabling you to develop strategies to reduce spending and contribute more money to savings. Number 2, automate your savings. Scheduling automatic allocations from your monthly income to either a savings account or retirement plan can help you ensure you are contributing to your savings on a regular basis. Consider creating separate accounts. Having separate bank accounts for different purposes, for instance, one for checking and one for savings, can help ensure savings remain untouched. Number 4, save different ways. Using different savings vehicles, such as money market accounts and certificates of deposits, can give you steady returns you can devote to savings and better protect you against market fluctuations. You can also put money into investments such as mutual funds to grow your savings. Consolidate debt. Consolidating debt, such as credit card debt, to a lower interest rate can aid you in saving money in the long term, helping you reduce your overall payments each month and enabling you to contribute to savings and retirement accounts. Number 6, consult a financial professional. And for us here at the Network Breakfast, that would be, of course, Rob Lord. Financial experts can provide a holistic custom savings plan based on your financial situation, which can allow you to grow your account balances as well as your retirement savings. Once again, a strong savings balance can help ensure long-term financial wellness. Doing so begins with looking at your savings strategically and creating both a budget and a family savings plan. And then, thank you. And I see on the bottom there, it says special thanks to Tyler Parker, Preferred Banking Officer at First Republic Bank, where they say it's a privilege to serve you. So now I have another slide that is part of, I'm not sure if we could see that, but I'm going to stop sharing. And then I'm going to share again and put this up. Okay, average bank account balance by age. We have median and mean. Under 35, 3,200. This is of as of 2019. If you can't see the small print there, it's from the Federal Reserve. These are interesting numbers. The 35 to 44, 4,700 to 27,900 for the mean. I'm not sure how this affects each of us, because if we go back to that first panel, I still know from selling a product years ago, back in 2012, that some 60% of 60 or 70-year-olds don't have $25,000 in a savings account. But that they didn't look at those people in this particular presentation. But in any case, my question to our people here is automated savings. Has anybody been on an automated savings? I know that I have, and I will tell you my experience. Okay, Rob Lord, who is our financial advisor here at the Network Breakfast, and who is referred to in our presentation. Rob, when did you set up your automatic savings? Was that long ago? Was that 5 years ago?
2007.
2007. Yeah. And it's proved.
So, yeah. So mostly my automatic savings is for my big ticket items each year. my insurances, auto, home, life insurance, vacation, Christmas. So I have X amount every week, just comes right on my checking account and goes right into a online savings account with a little bit higher earning. Right now it's about 0.5%. It just sits there, and I have a spreadsheet that keeps track of what goes where.
Mm-hmm.
And when a bill comes due, like I have vacation in 2 weeks, we have the cash to go. And we won't take all the cash out. We'll put some of it just on a card so we don't carry like $3,000 with us. But we'll be able to pay it off when we get home and not worry about it.
Mm-hmm. Okay, so this is a savings account that is not for retirement. This is for like
this is just a regular savings account.
If they had to put a name on it, this would be like a Christmas account. Only you're going to use it for vacations, for special purchases during the summer or whatever, which of course is a good thing to do.
And then I have another at the same bank. It's Capital One. They have a couple different types of savings. You could research it just on the internet, what gives you the best rates. But because this is money I'm going to use within a year, I'm not too concerned about how much I'm going to make on it, especially at today's rates. And I have one called a Harley fund. And that's what I saved to buy my Harley. And now, if anybody knows, HD for Harley Davidson really stands for $100. Every time you go to the Harley shop, it's at least $100.
So you're saving up to buy a Harley, are you?
No, it's just for different things like tune-ups, tires, insurance.
You already have a Harley.
I already have a Harley.
Okay.
So whenever I need something extra for it, like I just paid my insurance bill and I put $10 a week in there. And you'd be surprised how fast that adds up without thinking. Every Friday, $10 goes in that account. So that's $520 a year. I just paid $300 for insurance on Monday. But I transferred it over. It takes 2 days to transfer. So it's not something I can just grab and go. Just a day or two planning.
Mm-hmm.
So.
Wow. Well, naturally, that's all well thought out. And we would expect that from our resident financial advisor here at the Network Breakfast, which would be Rob Lord.
As for the loan consolidation, that's a tricky way to go to pay off debt. Yeah, you might save some in insurance, but what behavior is the biggest issue here is that typically when people get a lower payment, they consolidate everything. Guess what? They go backwards again. They rack up more credit card debt and other things, and they go backwards. One of the strategies we use is baby steps. This is by Dave Ramsey. And psychologically, it works if you stick with it. So we start off, the first thing you need is an emergency fund. This is when that guy named Murphy, there's a guy named Murphy, and he causes a lot of problems in people's lives. You know, Murphy's Law.
That was Peter Weller.
From RoboCop.
What's your name, son? Murphy.
Yeah. But so we look at the emergency fund just to give you one level of protection. That's $1,000. Get $1,000, keep it as cash. You're not spending that unless you have to. This is so when you wake up in the morning, you have a flat tire, you got to get your tire fixed. You're not putting it on a credit card and going more into debt. You have cash, you can get your tire fixed and go about your business.
Yeah.
And then we look at paying off our debt. We do use a debt snowball. So we want to list all our debts, smallest to largest, everything but the mortgage. Mortgage is baby step 6. That's just one of the things. Smallest to largest. And then we're going to pay as much as we can on that smallest debt and pay the minimums on all the rest. And when we roll over, when we pay off the first debt, we're going to take that entire amount, you know, plus all the extra we're putting on that and pay it on to the next one. And then roll that down the next one. So your payments are getting larger on each debt and you're paying them off. Mentally, emotionally, this works because you're seeing progress. You're able to cross things off. When we did this, we put a chart up on the wall and our kids helped us. We could cross off a debt and move on to the next one. And you know, some people try to do the math, say, I'm going to pay off the highest interest rate first. A lot of times that's one of your higher debts. And then you start working on that, you just don't get anywhere. And you're going at it forever and ever and ever. And it's just, you give up. People just tend to give up and go back to the way they were. Just, this isn't for me. But when you start seeing progress, I started off with 10 debts, 10 different credit cards and car payments and everything. Oh, now I'm down to 8. Now I'm down to 6. And they see their balances come down on what they owe. That's huge.
Huge.
So once you get that debt paid off, we look at step 3 is we want 3 to 6 months in your savings account as an emergency fund. This is if you were unable to work for 3 to 6 months, whatever your comfort is, how much do you need to survive to keep the lights on? And we're just talking basics. We're not talking about your Netflix subscription and your vacations and stuff. What do you have to do for your house payment? What do you have to do to all your utilities and to survive, and food and stuff like that? And then we get into our savings. Retirement savings is before college, because we will be retiring someday. Our kids have a lot more time, unfortunately, or fortunately, to pay off any debts they may incur for college, but plan ahead. And then our mortgage is part of that. We start putting a little bit extra onto the mortgage. And step 7 is just live like no one else, build wealth and live. Now, I put in the chat, my company Thrivent, we have a free program called Money Canvas. Money Canvas, you can sign up for that. And what they do is they help you with your budgeting. They help you with paying off the debt. It's an absolutely free service that you get. You get a coach, and they are pretty good. And there's some people that just have that one item that they know is important to them, you know, that they're just not going to get rid of, that might help them pay off their debt. They're going to work around that. They're going to work within your means and help you get there. And it's not something that they say, hey, you know, they don't contact me at all. They don't say, hey, you know, Jeff, thanks for this course. And then they contact me, hey, Jeff just graduated, he's doing well. They don't. I don't know anything about it. So, wow. You know, if you know people that are struggling or stuff like that, just mention that to them. And you can Google Money Canvas. You'll see
so it. If they just Google that, that'll put them in contact with where they could sign up for that.
Yep.
Money Canvas Thrivent. Excellent. And you know, you did all of that off the top of your head, so we know that how dedicated of a human being you are to this financial stuff. You did all of those recommendations, some of which that you're doing off the top of your head, and it's very impressive. Mm-hmm. Thank you, Rob.
Yeah.
Yeah.
A lot of the numbers I see are pretty accurate on average, but people that come to me, I may tend to see a little bit more of a balance in some of those, because they're the ones that are taking this more seriously. Other people just go through life paycheck to paycheck, and
sure,
you know, they're not thinking about it. It's too scary for them. It's not the way they want to live, because they might have to not give up looking like the Joneses every week and doing what the Joneses do every week. And I'm not, you know, calling out the Joneses. They might be nice people.
Sure. I also think that people that don't make a lot of money, we mentioned that 20,000 or less, they think they don't have to do any of this stuff because it wouldn't matter. I don't make enough money to worry about that, but they're the ones that need it the most. Even if it is, you put $1 or $2 or $3, you know, whatever you can, and to get together, put together a savings account of some sort. And it'll make, and the more you save, the more you want to save, and you'll find ways to not spend what you used to spend, and you'll make an effort to save money.
Yeah. Here's what I'll say to that: there are some people that just can't make more than that because of circumstance or disabilities and stuff. I get that, but there's also a lot of people that they're doing that. It might be like your 35-year-old son that's still living in your basement, the cellar dweller, because they play video games all day.
Oh boy.
and then they go out and do some DoorDash or something just to make that $20,000 a year. But to get past that, why can't you make more money?
Yeah.
Get a second job.
Second job, sure. Uber or
do
deliver
side
pizzas.
gigs.
Yeah.
Do something on the
Right.
weekends.
Work on the
so
weekends.
many deliver pizzas.
Yeah.
Well, gas prices aren't helping with that, but.
Well, all the convenience stores all need somebody to work. And if you can do Friday nights, nobody wants to work Friday night. You go in and work Friday night. And, these days, everybody's paying, what, 12, 15 an hour.
Mm-hmm.
You do that for...
I was at Target yesterday and I needed help. I couldn't find anybody. And even that red phone that you pick up and someone's supposed to help you, no one answered. It's just so sad. And there are no workers.
I don't know whether any of you people get Crane's Business, but I get Crane's Business, the magazine. I get it every day. They say that what has happened is, and I'll use a fictitious age group from 0 to 35, as far as the restaurants and this type of concerns, they don't want to work anymore because they think it's more important to have a good life than to work Mother's Day, Father's Day, all the major holidays. When you have restaurants, they're just not interested in working that anymore. They would rather have the free time. And this is right out of Crane's.
Yeah.
Sounds like mommy and daddy gave them too much too soon.
Amen.
Yeah, the work ethic. When I saw my father, all he did was work. And even though companies closed and left him high and dry without a pension, I mean, my mother expected him to get out there. You don't have a job, then you go. He worked at the job shops on the next to the freeway on I-90. There's job shops, like 100 job shops. My father would show up and make pieces so he could bring home a check every week, every 2 weeks, because his work ethic was amazing, and it absolutely translated to me. All I thought was, I work. That's what I do. I get up, I go work somewhere, and I worked at GE, and I played at night, and I did that for years. Yeah. Let's hear from Jeff. What do you got going there, Jeff?
I gotta wonder, how do we measure what accounts do we call savings in this measurement that we're looking at? Is that only bank accounts? Is that money market funds? Is it an investment account that's set aside for this specific purpose?
This particular presentation was only checking accounts and savings accounts.
Yeah, we talked about that.
It didn't even deal with what Rob was talking about, creating his Harley Davidson account.
Yeah, that's a savings account. That actually is. That would be counted in this. But I'm probably more of a exception than the rule right now.
Okay.
So I would. It's not counting the money under the mattress. It's not counting money that's in whole life insurance policies. It's not counting. I mean, that's where I put my savings now. That stuff's there, and if I need to access it, I can call them up and have the money and send it as a check right away. But it's also got a life, a death benefit associated with it. So, like, I have index universal life policies and whole life policies that aren't counted in this stuff. And I will say that my wife does have it set up so that when she gets her paycheck every 2 weeks, an amount goes into the savings account each paycheck.
And what's nice about that, in the future, if the cash value grows the right way, you can take that out tax-free for income.
Oh, I'm familiar with this, but you can take it out tax-free if you need it.
Yes,
right
that
now.
too.
I have access to these. For instance, I was able to pay for certain things for my daughter's bat mitzvah by just taking money out of my life insurance, and then I paid it back later. And the interest rate was lower than it was on a credit card, and it was. I knew exactly what to put back in, and I could have done it at any schedule I wanted rather than or not at all. But of course, I put it back in.
Right.
So you have access to your own money, and it's earning significantly higher interest than in the savings account. That's something that people should learn more about, I think.
Sure.
Probably have a conversation with Rob about that.
Okay.
But I also I own accounts on my kids' lives, and that will be theirs later. But right now I have access to that money too if I needed it.
And that's really a smart thing, to have a policy for your children. Like we offer some life insurance that actually has a guaranteed purchase option or guaranteed increase option. So
if I wanted to,
we might put a $25,000 whole life on them or universal life type thing. And then at the age of 22, every third year up to age 44, they can increase it by whatever increment we decide. There will be possibly an additional premium added to it to make it healthy. But I have a nephew, he was diagnosed with a malignant brain tumor at age 15. He's now 25, he's married. It has grown a little bit, but he's still going through some experimental treatments and stuff, but he doesn't have life insurance and he can't get it. Had he had a small policy like this, he could be doing increments and be protecting his family, his wife and stuff now. But you never know. You get to that age, you might find at that age a term life, as long as you qualify for it, might be better and less expensive for you for your budget. But that's something you need to discuss with a financial professional.
I wonder who.
I love thinking about this stuff.
Yeah, you could get a really nice little policy for your kids for less than $10 a month.
Sure.
Or you get a really good policy for I'm not going to say what they can cost. So
they could cost whatever you want to pay.
Yeah,
sure.
But that money's there when you need it.
Rob, since I never had these and didn't have kids, is this the kind of thing where some people like they would pay into it?
Hold on a second.
Okay.
He's muted, so now you can talk.
He's done.
You pay into it forever, and that's say something never happens to your kids. So some people feel like they've paid into that and then they've lost all that money. So it's a risk of whether something's going to happen or not.
Yeah, but you're transferring that risk so you don't have to. I could tell you story after story, tragedies I know. One of my son's friends from school, dad passed away. They had 5 kids and no insurance, and mom would stay at home during COVID. And we could all probably think of a tragedy like this over the past couple of years. I'm in my 50s and I'm seeing more and more of my classmates and people I know are, ended up passing away from heart attacks, COVID, just not waking up in the morning, accidents, and I don't know if they're all covered or not, but it's just, the unknown. So you take the risk and you transfer it to somebody else.
I wasn't
large company
sure that about transferring the risk. You mean the policy? No.
So if something happened to you, Trina, without any insurance, I mean, you're taking the risk that, and your husband, that if something happens, you're going to be able to pay for everything, and he's going to be okay without you. And then if you pay whatever amount to the insurance company, they're taking that risk on your life that you're going to survive that number of years. And if something happens to you, they're paying you a large sum of money. And the death benefit that's paid out is tax-free. So that's what I mean by transferring the risk. It's your risk if something happens with your family. And, as we get older, sometimes we might have enough assets that we're basically self-insured, which is great. There are some things like Jeff was mentioning, like tax-free income and stuff that might make sense if you want to transfer assets to your children tax-free and not worry about how much you're spending. And then, where was I going? But for a young family with children, just getting a term life is probably the most important. It's really inexpensive. And if something happens, the other person's going to be taken care of to help raise the kids.
Yeah, we had term life, but we outlived it. And then my husband, we never, with our health issues, we wouldn't be able to get life insurance was way too expensive now. So we would probably just sell our assets if something happened and have that paid for. But
Yeah.
we
And
tried again. We tried again to get life insurance. He had one grand mal seizure in college, one, and they consider that some form of epilepsy now,
Wow.
even though he's 67. And it was just way too expensive to get it at this age.
Mm-hmm. Yeah. And we do have on our company, you know, we're founded as an insurance company, so we have our own insurances, and we can also, if needed, shop outside of our company with several others, depending on the situation. But we have what's called a term conversion. And when I look at the cost of, it's a rider, but it's usually just pennies per month, you know, less than 50 cents extra a month for this. And what it does is give you the right and that you could change the policy and convert it to a permanent policy up until the end of the term. So if you have a 20-year term, you're 19, and it doesn't require underwriting. They don't ask any medical questions. You just say, yep, I want to convert all or a portion of this. Now you'll have to pay the new rates at your age, but you're guaranteed that insurance. You can put in a whole life and be covered. It's just an option. And for that little bit of a cost, I put it on every single policy that I write.
Wow. Very good. Chris, you have anything to add to our savings, our checking, anything going on?
Well, fortunately, I'm in a situation where my business pays for everything, okay? As far as insurance is concerned and things like this. I had somebody who, which is Mike Bentley, set this up so that anything happens to me, Andrea is taken care of. The business could, if it's, you know, they would pay off all the debt. There's enough money to pay off all the debts that I have. But we have no debt. The only debt we have is our house. And what I do is I pay an extra like $150 every month on my house payment. And I've heard that this will take it down from like 20 years to 15 to, you know, go that way. And it saves you a lot of money. So basically the only credit cards we have is through the business. And then I have a personal credit card that we use, but and I got an American Express card, but I pay all those off every month. So we have basically no debt. We have I won't say cash under the table, but I have cash. So I don't, you know, I'm okay.
Yeah.
I'm also seeing a new trend recently that a lot of the younger people, they're the ones that are working. So you have the two schools, the ones that just want to live life now as they're young and stuff, but you have the others that are driven. They want to work now before they have a family and stuff, and they want to retire in their 40s or early 50s. So, and they're making enough money and they're reaching out. It's hard to initially connect, but when you get in with one, it's all about the centers of influence. And, you know, once you get in with one and you take care of them, then your name gets passed around. But they're wanting to save. They're wanting to have income in the future. They want to get to the point that in their 40s, they can retire. And when they say retire, they just want to not have to work. If it's a passion, they'll continue. They might do it on a lesser basis. But it's a whole new thing now. And they do have the money to save. We're talking, you know, quite considerable amounts per month, more than we would normally think.
Very good.
You want to stop recording now, Tom?
Yeah.
Since it's just us.
I got to run. My wife just arrived.
Okay. Thanks very much. We'll see you next Tuesday, Network Breakfast. Thanks.
Great stuff, guys.
Adios.